Good day, everyone, and welcome. This is another webinar that we are preparing for you today that we hope will serve you well and add some value. My name is Michelle Fourie, and I'm joined today by AML CFD specialist Gamotso Molefe and senior analyst Themba Manganye. They're all from the Financial Sector Conduct Authorities, FSCA Supervision Department. Our webinar today will deal specifically with money laundering, financing of terrorism, and proliferation of financing sector risk assessment that stretched over the period April 2018 to December 2020, specifically on the securities sector. Now, to be able to share with you today just some introductions and background, I'm going to hand over to Themba, who I introduced, to take us through some high-level information about who is the FSCA, are we a supervisory body and who we supervise, and tell you a little bit more about the Financial Action Task Force and the mutual evaluation they conducted on South Africa in November 2019. Themba, over to you.
Thanks, Michelle. As an introduction, let me tell you who the Financial Sector Conduct Authority is. Herein will be referred as FSCA, the FSCA. The FSCA is designated as a supervisory body in terms of Item 1 of Schedule 2 to the Financial Intelligence Center Act, here referred to as the FIC Act. What is the role of the FSCA? The FSCA performs supervisory and enforcement activities on a risk-based approach. And who do we perform such supervisory and enforcement activities to? We perform the supervisory and enforcement activities to accountable institutions listed under items 4, 5, and 12 of Schedule 1 to the FIC Act. And those accountable institutions include the financial services providers, the collective investment scheme managers, and authorized users of an exchange, collectively referred to as non-bank financial institutions. The supervision of authorized users is delegated to licensed exchangers in terms of Section 45, Paragraph 1, capital letter B, subparagraph B of the FIC Act. Now I will introduce to you the Financial Action Task Force, herein referred as FATF. Please note that FATF is an intergovernmental body which sets standards to promote effective implementation of legal and operational measures for combating money laundering, terrorism financing, and proliferation financing of weapons of mass destruction. Please be aware that South Africa became a member of FATF in 2003. And also FATF has developed 40 recommendations which are required for a robust framework to combat money laundering, terrorism financing, and proliferation of financing. Take note that as a member country, in November 2019, FATF conducted a mutual evaluation of South Africa and assessed both our technical compliance in respect of our legal framework for combating money laundering, terrorism financing, as well as proliferation financing, as well as the assessment of our level of effectiveness in respect of identifying our money laundering, terrorism financing, as well as the proliferation financing risk, together with the mitigation of such risks that have been identified. Please note that one of the immediate outcomes of the assessment during the mutual evaluation, it relates to risk, policy, and coordination. I will now hand over to Humutso to give us more information about risk, policies, and coordination. Over to you, Humutso.
Thank you, Temba. FATF Immediate Outcome 1 addresses policy, coordination, and cooperation to mitigate money laundering and terror financing risks. The requirement is that money laundering and terror financing risks are understood and, where appropriate, actions coordinated domestically must be had in order to combat money laundering, terror financing, and proliferation. So what is FATF's expectation from countries? The expectation from South Africa is to properly identify, to assess, and to understand money laundering and terrorist financing risks, and to have measures in place to control or mitigate those identified risks.
So in line with Immediate Outcome 1 then, we said that this webinar is about a sector risk assessment on the security sector. So can you tell us a bit more what this sector risk assessment then entails?
Yes, Michelle, I can. The FSCA previously conducted a sector risk assessment, or SRA, in 2018-2019, which results were published on the FSCA's website in May of 2019. As good practice, and in order for the information to stay current, the SRA must be reviewed and updated on a regular basis in order to stay relevant. The FSCA has reviewed and has updated the SRA this time around for the period of April 2018 to December 2020. The SRA was conducted on 3 sectors that are supervised and regulated by FSCA. The first sector being the securities sector, second sector being the collective investment scheme sector, and the third sector being the financial advisory and intermediary services sector. This time around, Michelle, the assessment is going to be divided into 2 parts. This means that we will be publishing 2 separate reports. The first report is going to cover the securities sector, and the second report is going to cover CIS and financial advisory and intermediary services sector. For the purposes of this webinar, our focus today is going to be on the updated securities sector risk assessment. The report has been published and is available on the official website of the FSCA. So please visit the FSCA website and enjoy the report. The whole objective and purpose of the securities sector risk assessment is for the sector as well as for the FSCA to be able to identify, to assess, and to better understand money laundering, terror financing, and proliferation financing risks which may exist within the sector, as well as other criminal offences which are targeting the securities sector of South Africa. The scope of our assessment was limited to the evaluation of authorized users of license exchanges, AUs, and authorized OTC Derivative Providers, or ODPs. Although ODPs are not designated or classified as accountable institutions in terms of the FSCA Act, The FSCA, however, considered it important to also address the possible money laundering, terrorist financing, as well as proliferation financing risks which may exist in this sector as well, given that ODPs are market participants in the broader South African securities sector. So the methodology that the FSCA followed was the one recommended by FATF, which evaluates three areas, namely 1, criminal threats, 2, vulnerabilities or inherent risks, and 3, consequences. So the SRA can be used by AUs and ODPs as an important resource for feedback on money laundering, terrorist financing, and proliferation financing risks in the sector. This means that the FSCA expects AUs to review their risk and compliance management programs and to 1, consider the risks identified with specific reference to the red flags, the trends, the typologies, and vulnerabilities addressed in the report. Number 2, to refine compliance controls and mitigation strategies. Number 3, to also identify and monitor risk factors that may apply to their individual businesses. And lastly, but not least, to assist in reporting suspicious and unusual transactions or any money laundering or terrorist financing related matters to the FSCA and the FIC. What about authorized users? So South Africa has a very mature securities market and sector, which contributes to economic growth, to financial inclusion, and high levels of investment, domestic as well as international, and to the overall prosperity of the country. So what role do AUs play? AUs are persons authorized by a licensed exchange to perform one or more securities services in terms of the exchange rules. AUs engage in the business of buying and selling securities which are listed on an exchange. For example, the buying and selling of shares in a company, bonds, exchange-traded funds, derivatives, and other financial instruments. They can act as an agent on behalf of a client or trade in a principal capacity for their own account. Moreover, AUs can hold membership in more than one exchange. Let's look at the graph. As at the time of the risk assessment, South Africa had 5 exchanges as licensed by the FSCA and had 134 authorized users. The value of equity trades per day by authorized users was 23 billion rand, and the assets under management was 1.275 trillion rand. Authorized users also had a market capitalization of 17.87 trillion rand. And the last hex. The number of trades per day by AUs amounted to 467 million. So we can see that the volume and value of trades is very significant. What about ODPs? So OTC derivatives are financial contracts or agreements concluded over the counter between two parties and derive their value from the price of an underlying asset. The issuer of the OTC derivative contracts is called an ODP. In February of 2018, the Minister of Finance enacted into law regulations to the Financial Markets Act of 2012. These regulations govern the provision of securities services in respect of OTC derivatives by ODPs, including their authorization and regulations, under the Financial Markets Act. Some interesting information about ODPs and the OTC derivatives market. During the period of the sector risk assessment, the FSCA had authorized 7 ODPs, of which 4 were local banks and 3 were foreign banks. There were 61 applications for the authorization of ODPs that the FSCA was considering during the period of assessment as well. The South African OTC derivatives market comprises mainly of interest rate, foreign exchange, credit, currency, and commodity derivatives. And 75% of transactions in the OTC derivatives market related to interest rate derivatives. ODPs are required to report all transactions to a trade repository. However, to date, there are no licensed trade repositories in South Africa. Until then, transactions need to be reported to the FSCA. And lastly, but not least, 71.3% of OTC derivative transactions by South Africans were in respect of equity derivatives.
Thanks, Humutso, for the informative explanation. Please explain to us what are the criteria that was applied to identify the threats and vulnerabilities in the sector.
Absolutely, Themba. As part of the sector risk assessment and following the FATF methodology, the FSCA evaluated sectoral threats. So threats refer to criminal threats, including money laundering and terror financing risks that face the industry or the sector. In assessing these threats, the following information was considered. Number 1, we considered materiality. Here we looked at the characteristics and features of the sector. Secondly, we considered money laundering, terrorist financing, as well as proliferation financing cases that were investigated and prosecuted in the sector. We also looked at predicate offenses that were also investigated and prosecuted, including proceeds of crimes seized in the securities sector. We also looked at reporting information submitted by the industry to the FIC, as well as any trends that we picked up in the industry. So, in order for the FSCA to gather and collect comprehensive data and information for the risk assessment, the FSCA cast the net very wide for sources of information. We relied on information from the following sources as depicted in the graph. A, we relied on reports and intelligence from a variety of agencies, which included the Financial Intelligence Center, investigations that were conducted by the FSCA's Enforcement Division. We looked at data from the Financial Surveillance Department of the South African Reserve Bank, information received from licensed exchanges, and Straight, which is South Africa's principal central securities depository. We also looked at cases that were investigated by the South African Police Service, as well as the South African Revenue Services, including other government agencies. We also collected information from the results of the surveys that were issued to AUs and ODPs. And lastly, we had consultations with industry experts and bodies, namely the South African Institute of Stockbrokers. Here are some key information and statistics from the surveys issued to AUs and ODPs. The FSCA noted that the securities sector is characterized by frequent and numerous transactions, and that several mechanisms can be used to make proceeds appear to be legitimate earnings from the financial markets when actually they are not. We found that 17% of equities were held by foreign investors and that 83% were held by local investors. We found that foreign investors mainly traded in equities, for example, shares in companies. The JSE is the biggest exchange in the sector. We also found that 92% of AUs rated their clients as low risk. However, there were no money laundering, terrorist financing, or proliferation cases that were investigated and prosecuted in the securities sector during the period of assessment. But the survey results actually indicated that 9.2% of AUs and 21% of ODPs came across money laundering in their business in the past 5 years. We noted that fraud, insider trading, and tax evasion are the most common predicate offenses that were committed in this sector. And lastly, we found that 3% of AUs and 5% of ODPs indicated that their businesses have been abused for criminal activity during the period of assessment. Some more information and statistics. AU submitted over 1,000 suspicious transaction reports to the FIC to the value of a staggering 1.7 billion rand. Compared to all other sectors, for example, the banking sector, the number of STRs submitted by AUs is relatively low, as it only accounts for 0.03% of all STRs submitted. We found that the reason for submitting STRs by AUs related to suspicious and/or unusual transactions or activities monitored and mentioned in Section 29 of the FIC Act. This followed by that the activity does not match the client profile. We found that no TPRs or terrorist property reports were submitted by AUs. We noted that 21% of ODPs reported suspicious transactions to the FIC. Other information was that 1,249 suspicious transactions involving suspected money laundering were reported by ODPs to the FIC in the last 5 years. And lastly, the FSCA investigated 91 cases of insider trading or market abuse during the period of assessment. The SRA also evaluated the vulnerabilities or inherent risks within the securities sector. In this section, we considered the following risk factors. Number 1, clients, and some of the risk factors or indicators we considered were, for example, the types of clients, i.e. whether they're natural persons or legal persons, as well as the prevalence of foreign prominent public officials and domestic prominent influential persons. The second risk indicator that we assessed was products and services. Here we looked at the complexity of the products, whether products allow clients to remain anonymous. We looked at third-party payments or deposits, as well as the nature of the financial instruments that are being traded. The third risk indicator that we assessed was distribution channels. Here we concerned ourselves with the distribution of products through intermediaries of third parties. We also looked at non-face-to-face transacting, as well as the use of innovative technologies or payment methods. The fourth risk indicator we considered was geographies or geographic locations. Here we looked at the residence of clients in foreign jurisdictions. We also looked at the use of intermediaries outside of South Africa. The fifth risk indicator that we considered was the use of cash. Here we looked at the submission of cash threshold reports to the FIC. We also looked at the receipt and payment of cash. And lastly, we also looked at the mitigation of money laundering, terrorist financing, and proliferation financing risks. Here the factors we considered was whether accountable institutions conducted risk assessments and whether client due diligence was conducted.
So Kgomotso, you mentioned that you cast the net very wide and you have clearly gathered a lot of information that pertains to these particular vulnerabilities. I'm sure you have some very good statistics to share with the audience as they relate to the clients, products, services, distribution channels, etc.
Yes, I do, Michelle. And the upcoming slides are going to inform the audience of all of the statistics and interesting information that we gathered during the assessment. What the FSCA observed is that institutions operating in the securities sector are exposed to a wide array of clients. We also noted that vulnerabilities also increase due to having a large percentage of clients that are considered complex or multi-layered. Furthermore, there are significant vulnerabilities associated with the use of third parties by some institutions, especially when located in foreign jurisdictions or in the case of trading accounts held with different financial institutions. Since it can be difficult to obtain client identification, to do verification on such parties, as well as the limited visibility into a client's trading activity. What we can pick up or what we observed from the table is that NGOs are not a common client in respect of authorized users, with only 7% of authorized users indicating that they have NGOs as their clients. This can be contrasted, however, to NPOs, where we see that 24.6% of authorized users actually have NPOs in their client base. As we jump to natural persons, we see that 27.7% of authorized users indicated that they have natural clients in their client list or their client database. We also noted that legal persons comprise 70.8%, or rather that 70.8% of authorized users indicated that they had legal persons in their client base. Lastly, as we jump to the last percentage or stat, we noted that in respect of local or domestic natural persons, 46.2% of authorized users indicated that they do have natural persons in their client base. So what we can see from this table is that legal persons are predominant in the authorized users' client base. We also noted that approximately 25% of AUs had corporate clients that were part of an ownership or control structure that is complex or multi-layered. We also noted that approximately 28% of AUs had a client base which included domestic or foreign politically exposed persons. And lastly, also approximately 28% of AUs provided security services to clients using intermediaries or third parties. What about ODPs? What we can see from the graph here is that 43.4% of ODPs indicated that they have foreign national persons included in their client base. Further, we saw that 54.8% of ODPs had natural persons. Lastly, we can see that legal persons only comprise around 1.7, or rather that 1.7% of ODPs indicated that legal persons are included in their client base. So it is very evident from the presentation that natural persons are included in most of the ODP's client base. We also noted that approximately 26% of ODPs provided services to clients through intermediaries and third parties, and that approximately 37% of ODPs had a client base which included domestic or foreign politically exposed persons. The next risk indicator assessed relates to products and services. Here the FSCA noted that the main products and services which were identified as vulnerable to criminal misuse were 1. Client transactions and trading accounts in which funds in and out of the sector are primarily moved. Number 2, that trading activity itself can be exploited by criminals, particularly insider trading and market manipulation. This is mainly due to the large transaction volumes and speed of the trades. Thirdly, off-market transfers were also identified as vulnerable to abuse due to the transfer of shares and their value from one person to another without having to trade on a licensed exchange. And lastly, we observed that third-party payments as well were also highlighted, particularly in an instant where there is no apparent relationship between the authorized user or ODP and the third party. What we can see from the graph here are the types of assets which are typically traded, or the type of products which are typically traded. We saw that cash equities are predominant within the securities sector, where 70% of authorized users indicated that cash equities are the predominant asset that is traded. There's a steep decline, and here we see that equity derivatives, commodity derivatives, and financial instruments classified as others, 10% of authorized users indicated that these were also transacted in. We also picked up that approximately 95% of AUs did not allow their clients to use cash for purchasing securities. Approximately 43% of AUs allowed their clients to have more than one trading account. 52% of AUs provided security services on a non-face-to-face basis. And last but not least, approximately 91% of AUs did not allow third-party payments on behalf of clients. What about ODPs? With regards to ODPs, as evidenced on this graph, is that 36.4% of ODPs who participated in the surveys indicated that foreign exchange derivatives were the asset class of choice for clients. We see that 22.7% of derivatives of ODPs indicated that equity derivatives as well as credit derivatives were transacted in. Lastly, we see that 13.6% of clients transacted, or 13.6% of ODPs had clients who transacted in interest rate derivatives. We also noted that 68% of ODPs allowed their clients to have more than one trading account. Approximately 71% of ODPs did not allow cross-border transfers of funds or receipt of funds. And lastly, approximately 29% of ODPs facilitated trading in interest rate derivatives and bonds that were settled through an exchange. The next risk indicator assessed was distribution channels. Some of the key statistics included the following. Approximately 28% of AUs provided securities services to clients using intermediaries or third parties. 71% of AUs accepted instructions on a non-face-to-face basis. We also noted that approximately 22% of AUs had clients that have been physically present for identification and verification purposes. 1.5% of AUs used new or innovative technologies and payment methods to provide securities services. Also noted was that approximately 5% of AUs did provide or utilized online trading platforms and brokerage services which were not controlled. And lastly, approximately 9% of AUs had clients who have been introduced to the AU by a third party to the business activity which is unrelated to securities. In relation to ODPs, we found that approximately 26% of ODPs provided security services to their clients using intermediaries or third parties. Approximately 68% accepted instructions on a non-face-to-face basis, and 10.5% used new or innovative technologies and payment methods to provide security services. We also picked up that approximately 5% of ODPs had clients who placed a buy or sell instruction via different platforms. Whilst the use of online services is very low in the case of AUs and ODPs, the FSCA also noted that the use of online services to open accounts and trade creates additional challenges, mostly due to cybercrime and cybersecurity concerns. And lastly, ODPs did not utilize online trading platforms and brokerage services, which is not controlled, nor do they deal with non-banked walk-in clients. Geographies or geographic locations of AUs, ODPs, and their clients was another risk indicator analyzed. We found that approximately 43% of AUs had a client base which includes foreign financial institutions. Approximately 28% of AUs had foreign natural persons included in their client base. 1.5% operated in jurisdictions where money laundering is a primary concern. And we noted that 18.5% of AUs had clients that are registered in countries who are on the FATF grey list. We noted that AUs did not have clients who reside or registered in Syria, Sudan, Iran, Cuba, and North Korea. Lastly, we found that approximately 31% of South African securities, for example, bonds, equities, were held by foreigners or non-residents. Some statistics regarding ODPs were approximately 37% of ODPs had a client base which includes foreign financial institutions. 50% had foreign national person clients in their client base. We noted that ODPs did not have clients in jurisdictions where money laundering is a primary concern, and they had no clients which accepted orders that were not subjected to AML CFT checks. The report highlights that approximately 5% of ODPs had clients from locations which are known to apply excessive client confidentiality or have strict secrecy laws. We noted that 26% of ODPs had clients in countries who are on the FATF grey list. We also noted that 10.5% of ODPs had clients that reside or are registered in Syria, Sudan, Iran, Cuba, and North Korea. Before we move on to the next slide, based on the findings, the FSCA noted that AUs and ODP sectors are exposed to a relative degree of foreign jurisdiction risk. This is due to a certain percentage of ownership and trading in securities by foreign institutions.
Thanks, Umuto. That was wonderful. Under sectorial vulnerability analysis, you also indicated that you considered the use of cash. May you please assist with more information in relation to the use of cash?
Certainly, Temba. The FSCA also weighed in on the use of cash in the industry. It was noted that cash can be deposited into general transaction accounts and quickly transferred between trading accounts, which makes the sector vulnerable to money laundering. Some key statistics from the AU survey are approximately 5% of AUs accepted cash for purchasing securities, such as commodity derivatives and cash equities. We found that 2% of AUs had clients who had source of funds or wealth concerns and dealt with structured and large cash deposits. Lastly, the FSCA noted that AUs indicated that it was challenging to establish the source of funds.
Komotso, with regards to the use of cash, this certainly extends to the ODPs as well.
Yes, Michelle. In the case of ODPs, the survey indicated that ODPs had no clients whose nature of business activity involves transacting in large amounts of cash. Overall, the use of cash is not prevalent in the AU and ODP sectors.
That is interesting. So now that you have taken us through these statistics, I'm wondering if I'm an authorized user or OTC derivative provider watching this webinar, How does this sector risk assessment going to help me when I look at my own individual risk management and compliance program? What is the FSCA's expectations?
Thank you for the question, Michelle. The FSCA also looked at money laundering and terror financing risk mitigation and controls as part of the assessment. The FIC Act requires AUs to have risk management and compliance programs in place to conduct due diligence and to risk rate their clients. The following information comprises some of our findings. We found that all AUs conducted risk assessments on money laundering and terror financing risks faced by their business. We noted that 1.5% of AUs had clients who were classified as other and unknown, and which clients had not provided relevant information to complete the customer due diligence or know your customer process. We also found that approximately 3% of AUs had clients who dealt with funds which sources were unknown. Further, that 1.5% of AUs had clients who have made repeated changes to their profile information. Lastly, AUs did not have clients who purchased a security that did not correspond to the client's investment profile, nor any of the clients who have ever faked their identification or used false information to open or set up an account for trading purposes. Despite ODPs not being classified as accountable institutions in terms of the FSCA Act, ODPs that form part of a banking group still comply with provisions of the FSCA Act. We observed the following when analyzing the survey results. We noted that 5.3% of ODPs had clients that have been classified as other unknown or other. These clients had not provided relevant information in order for ODPs to complete the customer due diligence or KYC process. We noted that 5.26% of ODPs had clients whose source of funds is unknown and had made repeated changes to their profile information within a 12-month period. We also noted that 5.3% of ODPs had purchased a derivative instrument which doesn't correspond with the client's investment profile. And lastly, but not least, approximately 16% of ODPs had clients that have used fake or false information to open up or set up an account.
Thanks, Humuto. Now that you have shared more information about the threat and vulnerabilities in the sector, what are the possible consequences?
Thank you, Themba. The sector risk assessment also evaluated the consequences. Consequences refers to the impact or harm that money laundering or terrorist financing risks may cause or have on A. clients, B. financial institutions, C. the financial sector, and D. the broader South African economy. So what is the impact or harm that money laundering or terrorist financing may cause? In respect of clients, we noted that clients may lose confidence in the exchanges, which will result in them not investing money in the sector. Clients themselves may also suffer financial losses as a result of fraudulent activities or insider trading on their accounts. With regards to financial institutions, we noted that the controls put in place by financial institutions will minimize any harm or loss caused by money laundering or terrorist financing through these institutions. These controls largely refer to compliance with the FSCA Act, failing which financial institutions may A. suffer financial losses as a result of being abused for criminal purposes, may B. suffer reputational damage and as a result may lose clients. C. Financial institutions may decide not to do business with the financial institution that was abused for money laundering or terror financing purposes. D. The FSCA could impose administrative sanctions on financial institutions for non-compliance with the FSCA Act. And lastly, but not least, criminal prosecution of persons in the financial institution for assisting another to benefit from proceeds of unlawful activities or to finance terrorist activities. 3. In respect of the financial sector as a whole, the biggest harm to the sector is reputational damage, which may inhibit the capital raising process for listed companies and fewer investments will be made. Then lastly, in terms of the South African economy, harm or loss could lead to A. Economic instability, B. This could affect savings and investments, and C. Could impact the GDP of the country. The integrity of the financial system could also be undermined. And lastly, but not least, this may impact sovereign credit rating.
So Gemotso, in going through this whole process of looking at the threats and the vulnerabilities and the consequences, and seeing that we expressed the expectation for the accountable institutions to consider this assessment, I'm sure they are very interested to know and find out what your final results were.
Yes, Michelle, the results were very interesting. In conclusion, each sector was assessed as low, medium, or high risk in each area evaluated. These areas being threats, vulnerabilities, and consequences. All three risk areas were combined to give a holistic rating of the AU and ODP sectors. It must be noted that a rating of low risk does not mean that there is no risk within the sector. Money laundering can still take place through low-risk sectors. And similarly, a high-risk rating is not indicative of a lack of compliance in the sector. Some sectors, by their very nature, always have a higher level of inherent risk. The overall risk ratings, having assessed money laundering, terrorist financing, as well as proliferation financing risks, was medium or moderate. We found that AUs and ODPs were moderate in respect of these risks.
Thank you, Gemotso. And now I think the big question that remains is, how can the accountable institutions that are listening to this webinar get their hands on a copy if they don't have done so yet? So for the benefit of our viewers, the sector risk assessment on the security sector, as Gemotso has now very granularly explained to us, has been published on the FSCA's official website, and you can see the details on the screen of where to go. Our website address is www.fsca.co.za. You can scroll down to the grey banner at the bottom of the screen and hover over the heading of regulatory framework and click on that heading. It will then open a page full of colorful blocks. Go to the AML CFT block or tab, under which you will find heading for Financial Intelligence Center. click on 2022 and you'll find the publication. We are in the process of updating and refining the content and of our website tab and making sure that it's user-friendly, so keep an eye out for any updates in that regard. And of course, if you would like to contact us as the FSCA, Themba explained to you at the beginning of the webinar that we are as much a market conduct regulator as we are also a supervisory body in terms of the FIC Act. So for all your AML CFT related queries, you're welcome to contact us. If you have any comments about the webinar, please let us know. We're happy to hear from you. Until next time, we hope that you stay safe and well, and please look at the sector risk assessment. Consider it when you review your risk management and compliance programs. It will only add value. Thank you so much.